Hey guys, hope you are all having a great morning today. The brutal onset of the pandemic brought about many changes in the economy, most which were implemented to certain degrees by the government. The Fed became known for their endless printing of money, something that has had a myriad of consequences which we are starting to face. But at the time, it did not matter. Politicians scrambled quickly to find funds to be able to give to people so that they could survive the financial devastation that came about as unemployment and lockdowns. Money, it seemed, was cycling through everyone at that time, and many warned that the kind of change that was happening was too quick and would have long-term effects. Time went by, restrictions eased off and the government stopped giving as much financial assistance to people, slowly going back to where we once were, and for some odd reason, people aren't talking about the effects of this change that are displayed on the stock market. Today we are going to discuss how the tightening of money affects price volatility and builds uncertainty in the economy, while also touching on interest rates and how they will have to move sharply in order to have any chance to combat inflation. I will provide a link to my Discord in the comments and video description so that you can come join this little space where all kinds of important conversations are taking place. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. Back in 2020, money was everywhere, and people thought it would never go away. The Fed cut interest rates and starting buying bonds at record levels earlier in the year as a quick resolve against the looming economic hit that would have certainly brought the economy to a recession. Though we know the economy was in a bad spot, and that the future was bleak, there was money all around, as the government made sure that people had enough to spend. Now, things are slowly going back to how they were. The golden, or should I say green, era of fat pockets full of Benjamins is coming to a quick end, and investors are going to have to come to terms with the reality that things are not going to be how they were 2 years ago. Financial markets are also coming to terms with this reality, which is in large portion why they are trading the way they currently are. With investors expecting interest rates to increase a minimum of 4 times this year, with many analysts thinking the number will actually be double, hopes and prayers all lie in that this is a powerful and successful measure to combat and fight inflation, which has increased all the way to 7% as of December of last year. Last week, the Fed announced that it would end its bond buying program, signaling that rates would be raised soon. These recent changes and announcements are a really big deal, and just the teasing of what is to come has thrown a hammer in the asset markets. The S&P 500, NASDAQ and Dow Jones were all experiencing the historic performances, only to now near at 10% in losses for the month of January. Institutions and investors are incredibly worried about things to come and are slowly having to digest the reality that markets are simply way too overvalued at the current moment. All the easy money that came about and was injected into the markets by actions of the government will not be repeated in order to save them from a correction, making it really hard to anticipate where all the chips will land. And it's not even just the markets. As we have talked countless times, the housing market has blown out through the roof into the stratosphere. Homebuyers are having to contend with enormous mortgages as housing prices continue to soar with no real end in sight. Firms that were in financial holes because of problems with the fundamentals of their business took great advantage of government loans, but the majority didn't do like GameStop did after the squeeze, where they decided to end their debt and focus on new approaches and adapt their business model. The companies that decided to pay their board tons of money are now back in the same spot they were before. The government's debt to GDP ratio have bubbled. There are now huge deficits in big sectors, and we are starting to see the collapse in growth for emerging economies due to centralization of all powers consolidating around the same tired old companies. I talked about this before in another video, where I went over how there has been a dramatic decrease in companies being listed in the exchange and the large rise of ETFs that continue to consolidate around the same companies, mostly tech stocks and now crypto. For some reason, people often misconstrue tech stocks as defensive investments for some odd reason, thinking it's impossible for them to fall since they are valued so high. Well, Facebook just lost $240 billion in one day, and Netflix lost 30% of their entire market capitalization and right now seem to continue downtrending, meaning they are set to lose more than that. Because there is little growth in new emerging economies and so little newcomers, it's finally all catching up to the market. High indebtedness makes the economy more sensitive to monetary policy. As such, this is where the Fed must be extremely cautious handling the issues with hiking up rates. They must raise them enough to fight off inflation, but cannot be too aggressive because if they go too far, they will easily tip the economy into a full-blown recession as interest burdens will explode. If tighter policy caused turmoil in emerging markets, the effects of it will rebound on the economy, which is why so much depends on asset prices staying high. As I have previously said, right now the most volatile variable in all of this is all the way across the world in Ukraine. There is a serious potential and risk for a war to set out between Russia and NATO, and depending on how this conflict develops, and the amount of casualties that will result from it, will result in any action by the Fed to be too steep and send us all into a full-blown market crash. The markets are in a very weird and uncharted phase. Uncertainty is ruling over the minds of all investors and anxiety has taken hold of their actions. Because nobody is really certain that the strength in the economy is solid, alongside with the combined mistrust in the Fed's ability to really regain control of inflation, means that any little bad earnings report, every little disappointing number will have more abrupt effects on the market. Every little thing has an exponential consequences that will disrupt even major indexes for days. During the onset of the pandemic, we didn't see this only because the government made sure to hand out a lot of money to people, which meant that no matter what, things were going to get pumped with money and go up. Now that we are starting to revert back to normalcy, we are seeing just how ugly things can get, and how fragile the state of the economy has become overall as a result of the changes made to fight off a market crash that was certain to happen because of the pandemic. Last thing I need you guys to listen and pay close attention to is regarding the interest rate. Yes, I have said it a billion times and you have seen it on the news a trillion more. Interest rates will have to rise sharply to fight inflation, though not excessively as we just cautioned. However, this does not mean that the low-rate era is coming to a permanent end. This is not a black and white issue where it's one or the other going forward, and I want to talk about this a little more in detail, because I know that the majority of you think interest rates are about to go up and stay up, but the reality of economics is that low rates are not that far off again once this happens, so let me explain. In the short term, which means this year, the Fed does need to take drastic measures to try to get a full grip on inflation. It has grown out of control and now they need to press on the leash hard to get on top of things again. Interest rates are scary, because for decades we have gotten used to almost free money. Not a single central bank from any of the G7 nations has set interest rates above 2.5% for more than a decade, but back in the 90s, all of them were above 5%. This means that cheap financing has become a staple for almost every big developed nation, and has allowed for governments to continue running at extraordinary deficits that would have induced a panic attack just 2 decades ago. This is the reason why the surging of prices has caught the Fed by the balls. For so long they have gotten used to running the show with little caution, and in the past 18 months, inflation just exploded, reaching 7%, and eating up through the cost of life for everyone. Wages can buy much less than they could pre-pandemic, and even annual raises are not enough to offset the growth of inflation. To live well, it seems you need to make a solid 6-figure income, which most Americans certainly don't even come close to making. Global inflation reached 6% and central banks are spinning, worried as to their own ability to stir things back to normal. With the United States being the dominant role in the world's financial system, all eyes are on us. The most likely scenario right now is that interest rates in America will rise sharply, with experts touting 1.75 percentage points for this year. We all know this, but the question right now is, what about long term? Are rates going to be up for a long time? You have to remember, firms and homeowners borrow over years and decades, which means that if the outlook were to be high rates for years to come, it would be 100% unsustainable. Let's look beyond the Fed for a money and more at monetary policy, which is a more powerful force that drives the economy. Monetary policy is set around neutral rates of interest, and it's a fundamental rule which central bankers have little to no control over. The world is unlikely to weaken its stance on saving. For years, we have seen the growth of reserves of Asia economies slowing, but the world's inhabitants older than 50 is projected to rise from 25% to 40% by the year 2100 and will continue to go higher. Data shows that aging leads to more saving. It is because of this that I think it more likely that the aging population will keep a cap on interest rates down in the long term, and that the Fed will rise the rates. It will not be the end of the low-rate era. It has to do with an aging population and the human psychology to prefer to save money. Fighting inflation will have the serious risk of crashing the worldwide economy, but it is a measure that has to be done. However, I think the future will bring a lot of surprises to economists and analysts and all investors as they realize that this will not be the last time low rates will exist. And that is all I have for you today. I know this video was a bit more complex than usual, but I wanted to touch a little bit of economic theory with you guys today. I hope to have inspired a couple of wrinkles this morning, and I really hope you take a moment to let me know in the comments if you enjoyed the video and what your thoughts are. Don't just click off. Do leave me a comment with your opinions as to the matter or as to whether you like this type of video or not. For the love of tendies, join my Discord already, I promise you a good time in it. I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Hope you keep having a great day and I hope to see you later today on the recap video. Until then, keep on buying the dip into the moon.